2026 will set the stage for a much more robust recovery in 2027. If you read the headlines on jobs, you would swear we were in the middle of a depression. Mortgage rates had never doubled in a single year in the history of the United States before 2022. The economy is changing a little bit. We have a lot of people, like myself, that left corporate jobs and are working for our own businesses. We're self-employed. We did make housing unaffordable for a huge percentage of the population.
Hi everyone, and welcome back to The Digest by AD Mortgage, your trusted source for what matters in the mortgage world. Today, we're joined by a very special guest, Rick Sharga, one of the most respected housing market analysts in the country. You've seen him in the New York Times, Bloomberg, CNN, and Inman. Now he's here with us to break down what 2025 revealed and what our partners should be watching in 2026. Let's get into it. Hi, Rick. Thank you so much for being here with us today.
Thanks for inviting me. Nice to be here.
Let's jump in right into the questions. Looking back at 2025, what surprised you the most about the market?
The year was kind of boring in a lot of ways. We had a repeat of 2024 and 2023. Home sales have plummeted since the mortgage rates doubled back in 2022. And it looks like we're at this baseline 4 million a year home sales that we're kind of stuck in. It's a little bit of Groundhog Day. So I guess one of the things that did surprise me a little bit is how little market momentum we've seen going through the year. The other thing that's a little surprising is how resilient home prices have been. We've seen a lot of people talking about the coming home price crash, and home prices are going to fall 20-30%, and they continue to go up. December was the 30th consecutive month where home prices rose year over year. They only rose a little bit, but it's been kind of a market stuck in neutral for a few years, and it probably will start to get a little bit better in 2026 as we go through this period of recovery.
And in your opinion, how did the Feds manage inflation and rates over the past year?
The fact that the Federal Reserve, the way they managed inflation and the aftershock to the mortgage market really did make housing unaffordable for a huge percentage of the population. You have to really go back to the COVID crisis and the monetary and fiscal policies that were executed during that period of time. We went through the Fed's zero interest rate period for a long time. The Fed bought billions and billions of dollars of mortgage-backed securities to keep the market liquid. But what that did is cause kind of runaway inflation. And then to combat the inflation, they had to raise the Fed funds rate in a manner that we'd really never seen before. It went higher and faster than any Fed I've seen raise rates. And that created a shock to the mortgage system. Mortgage rates doubled. And mortgage rates had never doubled in a single year in the history of the United States before 2022. So those borrowers who were looking at $400,000 houses suddenly found out they could only afford a $200,000 house, and there were none of those on the market. So the Fed does have a hand in what's gone on in the housing market. I think they did what they had to do to get inflation under control, and they've done a good job of that. But it's been a really tough few years for the Fed. They had that dual mandate. They're charged with keeping employment full and keeping inflation low. And sometimes those two things run in a very contrary manner to each other. And so it's been a tough few years for the Fed.
And the government shutdown, since we're talking about the Feds, any lasting effects on the housing market?
Of the government shutdown? Probably not specifically. I think the government shutdown, if it had gone on longer, probably would have had some more severe implications for the housing market. The only really impact we've seen is a delay in the reports that the government puts out. So we had a delay in housing start reports and in new home sales reports. There were some delays in things like unemployment reports that the industry follows closely to kind of get a gauge on how healthy the economy is, but it really didn't have much of an impact. If there was a government action in the last year that probably has had an impact, it's the furlough program, the severance package that the administration put in place in January. We saw unemployment spike by about 173,000 job losses in October. People were wondering what that was all about. Well, that was when the 10-month severance package from the federal government expired. So the federal government went from hiring about 300,000 people in 2024 to laying off about 300,000 people in 2025. Most people don't realize that federal government employs about 3.3 million people across the country. So this administration wanted to pare down the number of employees, and that kind of thing can have an impact on housing, at least in local markets. So, but the government shutdown itself fortunately didn't last long enough to cause any housing market damage.
Where do you currently see the biggest disconnect between macroeconomic data and borrower sentiment?
That's a great question. There's the whole Wall Street, Main Street kind of conflict that people always talk about, and economists certainly talk about it. Wall Street's doing great. If you look at all of the stock indexes, they're performing at or just barely below all-time record highs. The Dow, the S&P, the NASDAQ are all performing really, really well. Most of the earnings reports coming out in the first quarter of this year so far have been pretty good. So Wall Street's doing okay. Main Street is having some lingering issues, and despite the fact that the country's GDP is growing and growing at a faster pace than most economists had forecast, despite the fact that unemployment's at 4.4%, which is very, very low historically speaking, and there aren't a lot of layoffs and firings going on, wages are going up between 3.5% and 4.5%, which is pretty strong. But consumer sentiment's at an all-time low. And I think what's really happening, the reason for the disconnect, is that the cost of living really skyrocketed during that period of high inflation a few years ago. And even though inflation's more or less under control right now, it's coming in at 2.6, 2.7%. It doesn't mean prices have gone down. It just means that prices are going up more slowly. But they're going up from those prices that spiked a few years ago. And so for a lot of households, they're really struggling to make ends meet. We have almost record credit card debt right now, which tells me that households are tapping into their credit lines in order to get their necessities taken care of. We have very low personal savings rate right now, which means that people are probably emptying their bank accounts to make ends meet. So I think that's the reason we feel this disconnect, that the economy looks like it's doing well. And for most people, it probably is doing well, or it's at least doing better than it was. But people are still suffering from the fact that, a few years ago, prices went through the roof. Anecdotally, the government publishes its CPI, its inflation numbers. I think they're a little bit too wonky sometimes, so I created my own CPI. I call it the Costco Price Index. And a couple of years ago, that salmon that I buy at Costco jumped from $9.99 a pound to $12.99 a pound, literally in a matter of a few weeks. And when you look at what the average household feels, that's probably a better read of inflation, because that wasn't a 2% increase or a 9% increase. That was a 30% increase in something that I feed my family with. I'm fortunate that I can kind of look at that and say, oh, it's an annoyance, or I can make a joke about it. But for a lot of people, that's the difference between buying that salmon and not buying that salmon. So there are real world consequences of these government policies.
And that really leads us into our next question, which is how concerned should we be about consumer debt in 2026?
Consumer debt is at an all-time high right now. We're at $18.7 trillion of consumer debt. We're at almost record highs in terms of credit card debt, auto loan debt, and student loan debt. The auto loan debt is at a record high in terms of delinquencies, and we've seen delinquencies on these lines of credit increase for 10 of the last 11 quarters. That all sounds really bad, and it probably isn't a good thing overall, but you also have to remember that part of this is what economists call a reversion to the mean. We're still not back to the delinquency levels we were at prior to COVID. So when COVID hit and all the government stimulus checks went out, people actually spent a lot of that paying down debt. So we had delinquency rates drop off pretty significantly, but they've been climbing. I am concerned about things like student loan debt. If you look at the mortgage industry in particular, student loan debt can be a kind of canary in the coal mine. The government started tracking delinquency rates on student loans in January of 2025, after a couple of years where payments weren't really required. The move toward 90-day plus delinquencies has just skyrocketed in student loans. In fact, if you look at industry data, you'll find that borrowers who have student loan debt are more often delinquent on their mortgages than borrowers who don't have student loan debt. Well, as the student loan debt gets more and more delinquent, at some point the government can start garnishing wages. And if they do that, the average wage garnishment is going to be between $700 and $800 a month. That's a lot of money for somebody to all of a sudden not be receiving in their monthly income. And that will either keep people from being able to afford to buy a house, or it will take those home buyers who currently, or homeowners who currently are in a house, and make it difficult for them to make their payments. So there are some things that the mortgage industry needs to watch in terms of this debt. Interestingly, though, the one area we haven't seen a huge spike in delinquency is on mortgage payments. So if you go back to the last big cycle, right up leading to the Great Recession, people were making their credit card payments, they were making their auto loan payments, but they stopped making their mortgage payments. And this time it's just the opposite. So mortgage delinquency rates are about 4% right now, and historically they're about 5.25%. So people are actually performing better on paying their mortgages right now than they normally do.
And are there any regional markets that stand out to you right now? Either positives, negatives?
From a housing perspective?
Yes.
During COVID, we started to see a lot of migration from sort of high cost, high tax areas, some areas with a lot of congestion as homeowners were looking for a little bit more space between them and their neighbors. And we saw people moving out of states like California and New York and Illinois into the Midwest, into the Plain States, into the South and Southeast. We're still seeing that kind of migration, just not at the same levels. But you look at regions like the Carolinas, like Tennessee, like Alabama, like northern Florida, we still see a lot of migration into those areas. And builders are actually building a lot of their new homes in the South, Southeast, and Southwest, because that's, again, where a lot of the population is moving. It's a really kind of complicated market right now if you look at home sales and home prices. Home prices nationally only went up about 1.4% last year. But if you look at the Northeast and the Midwest, prices are still going up 4, 5, 6, 7% because there's not a lot of inventory available for sale. States like Florida and Texas probably got overbuilt a little bit. There are some other issues, things like skyrocketing insurance rates, property taxes going up that are making affordability a challenge in those states. So we're actually seeing property values decline in those markets. So there's a lot of regional variation in what we're seeing right now, but by and large, we're still seeing a lot of people moving into the South and Southeast because it's more affordable, and because there are a lot of jobs there as well.
And regarding national headlines, what are you seeing our brokers and in general our partners are overlooking when reviewing those national headlines?
If you're really looking at national headlines and you want to take a step back and do a reality check, you really have to watch some of the politically oriented headlines that you see. For example, everybody expected the world to end because of the tariffs that the administration was threatening to impose on everybody. That was going to make inflation soar, and inflation, in fact, has come down this year. The cost of goods and goods and materials has not gone up as much as expected. So you have to take a lot of these financial headlines that are based on people forecasting what might happen, and kind of take a step back and ask yourself what the likelihood of that really happening might be. Because a lot of times the sizzle is a lot more dominant than the steak is. So I'd watch things like that. The jobs reports is another area. If you just look at the jobs numbers, we're creating fewer jobs. And when people actually ask me what I look at a basic economic standpoint in order to kind of gauge what's happening in housing and mortgages, I always start with jobs. How many jobs are we creating? How many are we losing? What's happening with wages? If we see more jobs, wages going up, typically that's good for the housing market. If you read the headlines on jobs, you would swear we were in the middle of a depression. Nobody's getting hired and unemployment's rising, and yet unemployment's at 4.4%. It's very, very low historically speaking. And we're still creating some jobs. The jobs market is not robust, but while we're not hiring a lot of people, we're also not laying off or firing a lot of people. So it's kind of like the market's stuck in neutral. So watch those headlines, pay attention to what the Fed's doing, but don't obsess over it. People have got to get into their heads the fact that the Fed can cut rates 2, 3, 4, 5 times, and it won't have any impact on mortgage rates. The Fed funds rate is not directly correlated to mortgage rates. So if you're really looking to figure out which way mortgage rates are going, watch what's happening with the yields on 10-year U.S. Treasury bonds. So it's know what's going on, follow the headlines, but take them all with a grain of salt.
Based on what you're seeing across the industry, how do you see lenders positioning themselves, and how do you think AD is positioning themselves?
The fastest growing part of the mortgage industry right now is non-QM loans. It's the not conventional loans. And I think that's probably going to be a trend we see continue in 2026 and beyond. One of the reasons for that is underlying economy is changing a little bit. We have a lot of people, like myself, that left corporate jobs and are working for our own businesses. We're self-employed. That kind of prospect really doesn't fit nicely in that conventional loan box. Much harder to qualify for a loan as a self-employed individual than somebody working on a W-2. So I do think that as the market has changed a little bit there, we also have an influx of borrowers who are forming multi-generational households, which is very typical in certain ethnic groups, but has not been the typical flavor, if you will, in the mortgage industry. So lenders that are able to accommodate these more non-traditional borrowers are going to be in a much better position to succeed than people who are kind of locked into those rigid 30-year conventional fixed loan guidelines. The other thing that I think lenders really need to be aware of, and this is really true for the independent mortgage banks that for years relied very heavily on refi business, is that market's not coming back anytime soon. We just don't have a lot of homeowners who would benefit from a rate-based refi, and we won't until mortgage rates are back down in the low fives or even below that. I think we're seeing a lot of the mortgage companies really focusing very heavily on purchase loans as opposed to refis, on non-QM loans. Investors bought 34% of the homes that were sold in the third quarter last year. It's the highest percentage in the last 5 years at least. They're not using 30-year fixed rate loans to buy those properties. So are you offering DSCR loans, or you're offering fix and flip loans? So I think it's an important market to be creative. And that's true in the wholesale channel as much as it's true in direct lending channels. And so I think companies like A&D are doing a good job positioning themselves with a wide range of loan products and approval cycles that are based on these kind of non-traditional borrowers. And I think those are the kind of mortgage companies that are going to succeed going forward.
What economic signals or indicators do you think our partners, correspondent and broker channel, should be looking out for upcoming?
I think brokers, lenders in general, should be looking at the same economic indicators I tell investors to look at. And this is boring. This is kind of investing 101. But you look for three things. You look for population growth, you look for wage growth, and you look for job growth. If you're looking at a market where all three of those are positive, you're going to have a good real estate market. And that's true whether it's a rental property or an owner-occupied property. You're going to have opportunities on both sides of that. You need to do that on a local market basis, not on a national basis. For example, the national unemployment rate we've talked about is about 4.4%. Well, it's more than a point higher than that in California. California's unemployment's about 5.7%. If you go to some counties in California, the unemployment rate's even higher than that. And wages aren't keeping pace with home price increases. So you need to have all of these factors in mind. If you're issuing a loan to a borrower, whether it's an investor looking for a rental property or it's a home buyer looking for a place to park their family, you need to know what those market conditions are to know whether that loan's going to succeed or not. The X factor in all this, we talked about this a little bit earlier, is insurance rates. If you're in a state like Florida or Texas, not unusual to have seen your homeowner's insurance double or triple year over year. If you're dealing with an FHA borrower or a borrower who just barely qualifies to get a mortgage, and suddenly they're finding out that their insurance bill's going up $200-300 a month, they're probably not going to be able to make their payments. And so we never had to think about insurance as a big part of qualifying or as a big part of whether a homeowner be able to continue to afford their home. But it's the new reality today, and I'm afraid it's a problem that's going to get better before it gets worse.
Lastly, you've been giving us advice this whole time. I feel like tips, tricks, but if you could leave our partners with one piece of general advice, like your biggest tip for 2026, what would it be?
2026, in terms of housing, I would say don't expect a miracle. In 2022, when mortgage rates doubled, affordability just cratered. We came through a period in time unlike anything we've experienced in the U.S. housing market ever. Coming out of COVID, home prices went up nationally about 45%, more in some markets. Following that, mortgage rates doubled. We've never had that kind of 1-2 economic shock to the housing market before. And you still see a lot of people on YouTube who are selling you courses on how to profit from the coming housing crash. Prices are going to fall 20-30%. That's not going to happen. But what was likely to happen, and I think what we've been seeing happen, is a very gradual, slow reset period where the market adjusted to these new higher costs. And typically when we've had shocks like that in the past, although not as bad as this time, it's taken 3 to 5 years for the market to adjust. To me, 2025 felt like we passed the midway point of that reset period. We actually ended the year with a little bit of momentum. We started January with some of the right momentum. We've seen list prices down a little bit compared to the prior 2 years. We've seen sales actually tick up about 2% in the first couple weeks. So I think 2026 is going to be a market where we see gradual but slight improvement. And I think 2026 will set the stage for a much more robust recovery in 2027. You have to weather the storm for one more year. I think 26 will be better than 25. But probably not as good as we'll see in 2027. So batten down the hatches, do what you need to do to get through this year. I think we actually are starting to see a light at the end of the tunnel.
Great, Rick. Thank you so much for being here. Great information you gave us today. Very, very interesting. We appreciate it.
Thank you.
That was a powerful conversation, the kind that brings perspective when the market might feel uncertain. Hearing Rick Sharga's take on the Fed's, unemployment, inflation, and what partners should be watching in 2026 was definitely a timely one. Now it's your turn. Do you think we're heading toward a soft landing or something else entirely? Let us know in the comments. Don't forget to like, subscribe, and hit the bell so you never miss a new episode. Until next time, take care, stay informed, and let's continue growing together.